So I was asked the question, Denzel, is there a difference between simple interest and amortized interest? And then I was also told that I was giving false information out. That's not good. We want to make sure that our information is not only valid, but we can back it up with what? Logic, mathematics. We are talking numbers and finances, so mathematics is going to be our best bet for our source of validity on whatever topic we are facing or talking about, right? Makes sense? Okay? And for all the current loyal subscribers and people that have been watching me for a while, you guys already know the primary differences between simple and amortized, which is why we're doing velocity banking in the first place, where we're leveraging simple interest lines of credit versus loans, personal loans, business loans, things like that. For all the new people here, for all the newcomers, for anyone that is discovering velocity banking for the first time and you have questions about whether this thing works or not, I'm gonna let you know right off the bat, I am not here to convince you, persuade you to do anything, because at the end of the day, it's your money, not mine. I am here to serve you only if you want to be served. I can only help people that what? Want to be helped. Let's handle the question. Hey, what's the difference between simple and amortized? Okay. And then handling the false information, which is really talking about, someone was like, hey, there is no difference between simple and amortized. And I just can't agree with that. I don't know. I don't know about you. I just can't agree with that. So let's use an example. Okay, let's dive into how we can pay off a mortgage. We're going to go over 3 ways to pay off a mortgage. Okay, let's dive into it. Here we have an individual making $5,000 a month. Expenses are $4,000. We have a debt, a mortgage debt of $300,000. Okay, here are the details. It's a 30-year fixed mortgage at 4%, and that is the mortgage payment, $1,432.25. This is a principal and interest only payment. Okay, we're going to take escrow, taxes, homeowners insurance, HOA fees, anything else that's on top of paying a mortgage. We're going to strip that out, and we're just going to pay that ourselves, which is a very wise way to do things, in my opinion. Pay it yourself. Don't let the mortgage company do it, right? Because the money just sits there and does nothing. It just sits in the what? The escrow account and does nada, but just pay the bill at the end of the year or by quarter or however you have it set up. When in reality, we could be paying that ourselves, leveraging the money ourselves, and getting results. Here we have the debt, and then our cash flow is $1,000. Okay? Now here is a line of credit for $25,000 at 10%. We are going to discuss whether it is not only better, but to also answer the question at the same time, what is the difference between simple and amortized? Okay, so we're going to go over the chunking method, which is velocity banking. And then we're going to go over what majority of people do in the United States, which is pay extra payments on their debts. Okay, in this particular situation, the mortgage. So we're going to go over the primary differences. And then the third way is to just do nothing. Okay, and just pay your bills. Pay your bills every single month. Now, I'm sure you can agree with me that doing nothing is the worst option. Okay, so we can cross that out. Because if we did nothing and just pay the $1,432.25 each and every month for 30 years, that's 360 months, times those two numbers together, you would pay $515,610. You would pay an extra $215,000 on your mortgage. if all you did was just pay the bill. So I'm sure you and I can immediately cross this out. This is not good. Okay? We don't want to do what everyone else does. Okay? Not going to get us the results that we want. Okay? So we can immediately cross that out. Let's go over the extra payment strategy. Okay? Which is also referred to as what? Debt snowball or debt avalanche. Something that a big individual that talks about a lot is Dave Ramsey. I think he gets credit for the debt snowball method. I'm not sure. But he is a huge advocate for it. I will agree with you. It is way better than doing nothing. Hands down. Way better than doing nothing. I'll agree with you on that. So, if we were to make extra payments every single month, what is our ability to make an extra payment? Well, we have to go off the cash flow, right? So if I was to pay an extra $1,000 per month towards my mortgage each and every month, you would pay off the mortgage in 13.33 years. That's a hell of a lot better than 30. Would you agree? Totally. Okay? You would pay a total of $389,000, okay? And you would save roughly $126,000 bucks. Not bad. Okay? This is way more ideal than doing nothing. I'll tell you that right off the bat. Okay? Now, the debate is velocity banking. Is it better? Okay? Is it more effective? Do we get better results? Mathematically, can we prove that? Sure we can. Okay? Haven't already been doing it on my channel, all the videos that we put out already, but hey, skeptics will be skeptics, okay? Doubters will be doubters, haters will be haters. It is what it is. At the end of the day, I'm here to educate. I'm your teacher, okay? And I know you trust me to give you the proper information. So here is an example. I did 4 different examples on how we would get better results, which is take that same 1,000 cash flow, and the only thing we're adding to the situation, is that we have a line of credit for $25,000 at a 10% interest rate. Simple. We're going to go over that. If day one, we both start at the same time, both have a 30-year mortgage, 4%, same payment, same income, everything's the same. The only thing that changed is that I have a line of credito. To begin with, if we made an initial chunk payment, chunk is referring to the amount of money that I take out of the $25,000 that the bank gave me, okay? So if we do $14,000 as our first chunk, all right, how long would it take me to not only zero out the balance on the line of credit doing velocity banking, but also give me the ability to make my next chunk? Okay? Let's think about that. Very, very easy to do. You first need to calculate your cost of borrowing. The easiest way to do that is you take the 10%, okay, and you times it by however much money you initially took out of the line of credit. Okay? You're going to get a number. You then divide that number, in this case it's $1,400. You divide that number by 365 days, and you'll come to a conclusion. That average, I'll pay anywhere around this amount, okay, which is going to be like $3 and something cents, okay, which is how much money you'd pay per day over here on the line of credit. Sound good? Cool. So now, to figure out how long and when can I make the next chunk payment, doing velocity banking, to pay off the mortgage is pretty simple. You just take the 14K, right? What Velocity Banking says to do is to put your income back into the line of credit in full. And then you take expenses out. Expenses. You take it out. Okay? What stays in is the cash flow each and every month. Now, what's interesting is this 14K right here, in whatever month that you're chunking, let me ask you a question. Does it satisfy the mortgage payment of $1,432.25? Yes or yes? Yes. So if that's the case, then for that specific month, guess what? My expenses are not $4,000. They are less. Okay? $4,000 minus $1,432.25. Write that down, see what you get. That is the actual amount of money that will be coming out of the line of credit to pay your bills. Okay? So technically, for the very first month, your cash flow is going to be well over $2,000. And then every month thereafter, it'll drop down. Okay? Now, safely, you can say that it would take you anywhere from 9 to 10 months, okay, to completely zero out the line of credit. 9 to 10 months. Okay? Write that down. Cool. 9 to 10 months. When I reach this number where the line of credit comes back to zero, so technically I paid off the $14,000. In the same time of paying off $14,000, what else are we doing? We're paying $1,432.25 each and every month thereafter, are we not? Sure. Okay. So if we know that and we know that, then the next question is, when can I make my next chunk? You can make your next chunk immediately when you zero out the balance on the line of credit. So here is a synopsis. Here is an idea. If you made an initial $14,000 chunk and then you decided, okay, I can safely do $10,000 chunks every 6 months, you would be done in 105 months or 8.75 years. Not bad, senor. 8.75 years. Not bad at all, mom. Right? 8.75 years is a hell of a lot better than 13.33. Would you agree? Okay? Here is the difference between simple and amortized. I'm using a simple interest debt to pay off an amortized debt. You gotta understand how amortization works on the 1432.25. Okay? The difference is the amount of money that I'm paying extra on the mortgage. See, this person is just doing a measly thousand. What they don't realize is that extra cash flow dies in the form of interest. Okay? Not only does majority of the 1432.25 go towards interest in the very first 10 years of your mortgage, okay? But so does this 1,000. You know why? The 1,000 is not more than the mortgage payment itself. So you can't tell the mortgage company, hey, put that all towards principal. You may. Some mortgages are different than others, but I don't know this for a fact, but I think for the most part, mortgage companies will not allow you to just put 1,000 straight towards principal. Some of that will have to go towards what? Interest. Okay? Whereas on this side, the 14,000, okay, minus the 1432.25, right? You just minus the 2. That difference, that 12,000 and some change, you can say, I want to make a principal only payment of that amount. And that immediately wipes out any interest from accruing on that money. And then you also obtain instant equity in the mortgage. Instant. Whereas over here, we do not gain instant equity. Therefore, our money kind of dies in the process of paying off debt. Which is why, in the same time, this 13.33 years that you were paying $1,000 each and every month, when it's all said and done, when you're debt free, guess what? This person right here is broke. Why? Where's all their money? Gone. Majority of it gone. The rest in equity. But see, if you attest to this strategy of the debt snowball, then you can't do what I do and borrow money, right? Because that goes against the rules. Goes against the rules. Can't do it, right? So if you're going to use my strategy, you might as well jump over here and let's have a conversation and let's handle some work. So let's up the ante a little bit. Let's up the ante. What if did the same thing? Initial chunk of $14,000, and you said I'm going to make an $11,000 chunk every 6 months. Can we do that? Sure we can. Why? Because you have the space to do so. See, what also becomes very interesting with velocity banking is when you're actually in the process of paying off your initial chunk, right? And then every chunk thereafter, we don't necessarily have to pay off the line of credit in full to give us the ability to make our next chunk. Do you know why? Because of the available space. That's why. And because of my expenses. The most that my debt will ever be on any chunk will be right around this number. Or as high as this number. But it'll never go more than that, right? And then if you minus it from the total credit line of 25,000, guess what? You have what's called an emergency fund right there, sitting, available, right around 10,000, readily available for unexpected expenses, emergency, hospital bills, job loss, life. Whereas over here, where is your security? Your security was the 1K and the 1K only. See, when you're doing this method, how can you solidly invest or save money in the process of doing this? I don't know. You're going to have to coach me on that because I don't see it. If the cash flow remains at 1,000 for the whole entire time period, where can this person save, create an emergency fund, okay, at the same time of paying off debt? You would have to add to the timeline to do what? Create an emergency fund, buy a life insurance policy, invest in a mutual fund, a 401k, an IRA, whatever they tell you to do, right? Whereas over here, I can do everything at once. I've got my savings right there. I've got my emergency right there. I've got my investment right there. Not bad at all. So anyways, let's say we did the 11K chunk after the 14 every 6 months. My friend, we'd be done in 98 months. That's 8.16 years. Not bad. up the ante a little bit more. Get a little more aggressive. You've got the space to do so. 12,000 every 6 months, done in 92. Now we're talking 7.66 years. And you know what? I decided to be very, very petty, because I see a lot of YouTube videos out there that they talk about, oh, pay an extra $100 on your mortgage and you'll save 30-something thousand dollars. That's baloney. That is baloney. Okay? So you know what? I decided to be very petty and apply that 100 into my velocity banking strategy. Okay? Where we do 12,000 every 6 months after the initial 14, okay? Each time, right? 9 to 10 months is how long it took for 14, okay? At the max, it'll probably look a lot better. You probably get done in like 8, okay? But 9 to 10 months, being conservative, okay? And then do 12K every 6 months, same. And then every chunk, every 6 months, every chunk after the 12, increase it by $100. Just 100, okay? You would be done in 88 months. So you would shave another 4 months off your timeline, 7.33 years. You would save an extra 14, 32, 25 times 4. Not bad at all. Now, here's where the debate occurs, where it's like, Denzel, that's not fair. Hey, life's not fair. Okay? You're like, wait. That's not fair, because how is this person able to do a $14,000 chunk in the beginning and have it done in 9 to 10 months if the cash flow is only $1,000? How is that possible? Okay? Then the other question poses is, every 6 months thereafter doing 10K chunks, how is that possible? How is that possible with only 1,000 cash flow? Denzel, I think you're a liar. I think you're giving false information out. I don't like your strategy. Hey. Again, I'm not here to convince you. I'm not here to persuade you. I'm just showing you mathematics. Do what I said right here. Put 5K in, take 4K out, cash flow stays in. But you got to remember, every time we do that chunk of the 10, guess what? Gonna minus the expenses, creates that cash flow ability. And the other thing that I have an advantage over this person is the what? The space. The space. Space is key. So is cash flow. Cash flow is very important. Space is what's gonna help me actually make these $10,000, $11,000, $12,000 chunks every 6 months to speed up the timeline. Okay? So when we break it all down, on average, velocity banking goes about 5 to 7 years faster than debt snowball. That's a lot of $1,432.25 payments that we saved doing velocity banking. Okay? On average, you save an extra, in this example, we saved an extra 35 to 40K on top of that number right there. We save an extra. Okay? And when doing velocity banking, it's less risk by keeping the cash flow. Remember, at the end of the day, we'll always have this line of credit. And we'll have equity a lot faster than that guy or gal. So we keep our cash flow because of how much faster we went than them. Okay? So I hope I tackled those questions on the difference between simple and amortization. You know, is one different than the other? I believe so. I believe if I leverage simple to pay off amortize, I'm going to go a lot faster than the guy that just says, I'll just pay directly into amortize and be done with it. Okay? Hope this helps. If you have any questions, comment below. Like this video, subscribe, become a part of this family. If you'd like to work with me one-on-one, where I break down numbers, throw them up on the board, I put you on the hot seat, I put myself on the hot seat, and we handle the goal, which is to pay off debt increase cash flow, lower expenses, build your credit score, all using your own income so that we may create a legacy and create wealth for our families. Okay? God bless. Have a wonderful day.